Hi there. In this personal lesson video, we are going to continue on the yield curve. We're looking at two shapes today: steep yield curve and flat yield curve. In the steep yield curve, the time that investors are waiting to realize return is collapsing. So the curve is steep. So what it means basically is that markets expect quick future economic growth. So expect that there will be quick change, and it's happening in the future, but it will be quick, it will be faster than normal yield curve. And then flat is literally when short-term rates and long-term rates are literally equal. There's maybe 1 or 2 basis points differences. And what that means is that investors expect, just normal growth. They expect that inflation starts falling. And most times, flat yield curve is an indication. It means that either the economy is about to enter a recession or it's coming out of a recession. So it's a circle. The curve is flat. It can either go down or it can go up. So it's a point of inflection. It means investors don't really require a premium for the long-term investment